is that the current financial system and monetary system that exists in the world today is starting to come apart at the seams. And nothing more, the most obvious thing to see if you want to look at that is what the central banks of the world have been doing. They've been buying up gold at the rate of over 1,000 tons per year for the last 3 consecutive years, and I'm sure it's going to be 4 consecutive years, by the time this year is done.
Monaco 64, home of alternative economics and contrarian views. Today I have the pleasure of speaking with Ed Steer. His blog is edsteergoldandsilver.com. He's been interested in the precious metals market for about 45 years. He was involved in the late 1970s, 1980 gold and silver bull market. He's written research for Casey Research, for Stansberry, and he's a member of the board of GATA, which is Gold Antitrust Action Committee. Ed, welcome to the channel.
Hi, Mario. Well, thank you for having me on, and to greetings to all your listeners. And I want to start off by saying I haven't been around in the precious metals for 45 years. It's been a bit over 25, but it feels like I've been in it forever, with the markets being what they have been for the last quarter of a century.
Yeah, I read in your blog that you were involved. You made some money, you said, and you lost some in gold and silver in 1979, 1980. And I think afterwards you left that market and came back 25 years ago.
Oh yeah, that was the Hunt brothers way back then. Yeah, that was that was like a lifetime ago. I was in my early 30s at the time, and
yeah,
like I said, I made a lot of money in this, and then I promptly lost it all when, of course, they changed the rules on the COMEX, and the Hunts got hung out to dry along with other investors. So, but like you said, I was in the market for like 3 or 4 or 6 months, and after that, my enthusiasm died until the internet came along in our house about 1997. And from then on, my interest in the precious metals has grown into what it is today, which is consumed my life for the last 27 or 28 years. So
yeah, same here, kind of since 2002. Once you go down the rabbit hole, it's difficult not to. It's difficult to get out of it, and that's what happened to me the first time I bought some Krugerrands in 2002. I started reading about gold, and I learned that there is such an important part of the monetary system. And Ed, I used to work in the financial markets, and I used to watch the bond market because that's what I worked as a bond broker. But when I bought gold, I started following the price action of gold because I was interested in it. And I found some really unusual patterns that I couldn't find in any other market. Like it happened all the time. For example, here in London, it was around 1:20 or 1:30 p.m., which was around the opening of COMEX. The market always seemed to drop. So with that, I wanted to ask you about if you want to call it manipulation, price management. And a lot of times people ask why do they do it? Why do they try to suppress the price if the price has gone up so much over the last 25 years? Have you got an opinion on that?
Well, certainly. I mean, there's been a COMEX futures market in gold since January the 2nd, 1975. And from then on, instead of having just a physical market, it became a paper market. And the major bullion banks of the world, led by the US bullion banks, of course, and the ones in Britain, have been managing its price ever since. They've allowed it to rise because they just don't have any other choice in the matter, but they've effectively been controlling the price, since way back in 1975, and I've written extensively on the internet about that. It's very simple. I mean, we're now on a fiat currency system worldwide since 1971, and the object of the exercise by all these bullion banks and central banks of the world is to prevent people from running to the paper asset side of the street into the hard asset side of the street. and thereby making their fiat currencies worthless. Because once people are discover that they're being robbed blinded by inflation and currency debasement, their natural reaction is going to be go for gold. And we're seeing after 50 plus years is that the current financial system and monetary system that exists in the world today is starting to come apart at the seams. And nothing more, the most obvious thing to see if you want to look at that is what the central banks of the world have been doing. They've been buying up gold at the rate of over 1,000 tons per year for the last 3 consecutive years, and I'm sure it's going to be 4 consecutive years, by the time this year is done. So, if they're running for gold because now it's a tier 1 asset with Basel III Accord, if they're running for gold, everybody should be doing it, and you're seeing signs of that in the price in the last 3 or 4 months since the beginning of the year. That now it's become an absolute stampede, not only into paper gold like the ETFs and stuff, but by the physical demand. For that's all the gold that's been flown from London and Switzerland and all over the world to the United States. I mean, it's. You don't hear anything about it in the mainstream media, but let's face it, the run for gold and silver and other hard assets is on in earnest right now.
Yeah, I remember back in January this year, the FT came out with an article about the delay for spot delivery on the London or LBMA market by the Bank of England. It was like spot became 4 to 8 weeks. Where do you think this physical gold? Who do you think is shipping this physical gold into the US? I think it's over 2,000 tons now, isn't it?
The numbers I have that going, I have the numbers that are going into the COMEX, and since the beginning of the year, 27.5 million ounces of gold has been shipped into the COMEX. Now, the bit's been shipped out since, but up until, say, the first week of April, there's been 27.5 million ounces of gold shipped in, along with 200 plus million ounces of silver. Now, it's all coming out of the LBMA or Switzerland or, I saw the stats from Nick Laird's website. The gold that went into the U.S. came from everywhere: Australia, Canada, Kyrgyzstan, Switzerland, and a whole pile of countries. And what happened is that all the bullion banks that were holding long contracts in the COMEX futures market decided they didn't want the paper anymore. And they advised the shorts, the ones that were short against them, which were other bullion banks, by the way, that they wanted to take delivery, and then the mad rush by the banks to take physical delivery instead of having paper contracts in the COMEX began. And like you pointed out, it began on January the 1st, and the rush has been so great. There's basically delays in delivery out of the LBMA and the Bank of England, which is where all this gold is coming from. So, I don't think it's let up very much, but however, like I said, it's seen a dramatic slowdown since the first week of April. But we're seeing it. We're still seeing it in some areas where it's now starting to go into the ETFs and mutual funds, where the John Q. public is starting to get involved. They've dipped their toe in the water in this. But the public per se, like Joe Sixpack, have not been involved in this bull run at all. This has been all paper trading, and all the big boys, the big bullion banks, they're the ones that are demanding delivery, taking delivery. We're talking hundreds of billions of dollars, that they're spending to get physical delivery. But Joe Sixpack, the John Q. public is just not involved up to this point. But the day they are, we're going to see the prices really start to soar, especially as the institutions start getting involved, which we're seeing signs of right now.
You spoke about Basel III earlier, and I was actually having a discussion with someone about Basel III because they were saying that it wasn't really impacting demand for gold. Could you explain to the viewers how the new Tier 1 classification for gold works and how it affects the bullion banks? To my understanding, it's if the banks hold unallocated gold, it only counts as I mean, there's like a 15% that is risk free, and if they hold allocated in their vaults, there's no risk. So maybe you could, and also maybe you could give your opinion on whether that's also impacting demand for gold in the US, because there are some people saying that the US is going to implement Basel III from the beginning of July.
Well, what you're saying is absolutely true, and that's what I've heard too. Is Basel III goes into effect in the U.S. On July the 1st, and what you said about is it allocated, it's allowed to be used as a tier one asset 100%, and if it's unallocated, it's a percentage less than that. 15% is probably correct, but I'm not exactly sure of the number. But what happened is this: is that the major the BIS, which is the bank's central bank, finally decided, enough of this. The U.S. dollar, they could see the writing on the wall for the world's reserve currency, the U.S. dollar. And since there was no other currency, paper currency in the world they could substitute for it, because they're all the same, they're all fiat currencies, they had no choice but to make gold, which has been money for all of recorded history, a tier one asset, which means you can put it on your books at face value, which before Basel III, you could only put it on your books at 50%. This was the International Monetary Fund's attempt to discourage the use of gold in the financial system. But this current financial system is very long in the tooth. And finally, the writing was on the wall, and they had no other choice. That was why they did it. They just had no other choice except to make gold a tier one asset. So now it's on everybody's books. And any central bank or anybody that's holding gold, I bought gold back in 2000 like you did, plus silver and the whole 9 yards, has seen substantial gains on their holdings. And, the central banks aren't stupid, and they're big buyers, and they're going for the gold, and they've become gold stackers just like everybody else. And for the same reason you just mentioned, that it's now a tier one asset like the U.S. dollar. And with the U.S. dollar, heading for the nether reaches of the earth at the moment, and Mr. Trump, going overboard in all his tariffs and stuff, nobody knows what's really going on out there. So what happens in a world like that? Everybody rushes for gold, and like I said, the central banks have been doing it in spades now for the last 3 years, and I don't think that's going to slow down until like you said, which you pointed out, you're having trouble delivering it in London. And I would think that, with the demand that we're seeing, that, we're probably going to end up in a physical shortage in gold like we've had in silver for the last 5 years.
And talking about physical gold and central banks accumulating physical gold over the last, since 2022, especially, do you think that the U.S. Treasury is trying to repatriate gold? Because, from what I learned about GATA, the when I started looking into gold manipulation, because I used to see the price do the same thing every day, I learned about the gold leasing, how the Treasury leased a lot of its gold under Robert Rubin to keep this strong dollar policy. But now, if the dollar is going going down to the nether regions, as you said, and the whole world is going into gold, China, Russia, and all the BRICS, and even some Eastern European countries buying a lot of gold. Do you think that Trump and Besson have come in and they've said, wow, we have to repatriate all this leased gold? Do you think that's what's going on too?
It's entirely possible, but the gold market is so opaque, and if the Treasury Department and the Fed U.S. Fed are actually doing it, they would be doing it through the major U.S. bullion banks like J.P. Morgan and Citigroup, Wells Fargo, and the like. And we wouldn't know who, when J.P. Morgan, whoever takes delivery of all those contracts of gold, we don't know who their customer is at all. So it could be the U.S. Treasury, and as far as Fort Knox goes, and all, it's been talked about endlessly for the last 2 or 3 months. Is, they say they got 8,100 tons of gold, and they may have it, but a lot of it's coin melt, so it's not what you would call good delivery. That's not the problem. And as you alluded to, and as others have already spoken of, is the fact that it's not a question whether the physical gold is there or not, which is, of course, worth looking into, but how much of that has been leased out? How much of it has been swapped? How much paper has been written on it? How much of the U.S. gold reserves are encumbered? And, not only that, but the gold at the New York Fed as well, or at West Point. And I think if you lifted the lid on that, you would see that, the amount of gold that the U.S. has that they actually own is only a small fraction of the 8,000 tons. Nobody wants to look under that rock, but I'll tell you what, if they did, it would blow the gold market wide open. I think Frank Veneroso did a study on this like 25 or 30 years ago, where he said, he figured at least 30% to half of the world's central banks have written paper against their gold, which has already been sold and is hanging around the necks of people in India or Vietnam or Singapore or China. So, the figures they bandy about that we see in the official reserves, you can bet your last nickel that it ain't all there.
Yeah, and what about silver? I mean, we're speaking here on the 23rd of April, Wednesday, and recently we've seen gold shoot up. I mean, last week it was, I think it settled around 33.27, and then earlier this week we got up to 3,500. That's the spot price, and silver is still lagging. The gold to silver ratio went above 100. But today things seem to have reversed. Gold's still dropping today sharply. It's just below 3,300 now, and silver is above 33. Do you think this is when silver wakes up? Because a lot of people, the silver bug, so to speak, they've been frustrated by the fact that silver is still here below 50, while gold is like above 3,000.
Okay, well, all this price run up that we've seen in the last month. Okay, and I watch. I do the Commitment of Traders report every Saturday, where I analyze what's going on in the COMEX futures market. And the small commercial traders have bought, I think it was 80,000 gold contracts. They've covered 80,000 short. So they bought 80,000 long contracts, and it's their buying that's driven the price up. And they're keeping a lid on silver. There's no question about it. And what we see today is, the banks in the COMEX futures market were covering as the price. Their buying drove the price up over the last month, and now they've engineered the price lower, and they're covering short positions on the way down. This is all paper trading. I was just as surprised as you. I was up, at the London Open this morning, and I'm looking at the price, and I'd say, gold is down, what, $100, and silver is up like 80 cents or whatever. And I've never seen that before. And I can tell you right now, it has zero to do with supply and demand, and everything to do with paper trading in the COMEX futures market. Now, this all happened after the COMEX close. Started after the COMEX close yesterday, which is the cutoff for this Friday's Commitment of Traders report. And all the price action that we've seen since the COMEX closed in New York yesterday, including the big engineered price decline at the Globex Open at 6 o'clock in New York yesterday evening, has occurred after that date, okay? And won't be available to for public knowledge until the following Friday COT report. And silver analyst Ted Butler was, on to this 20-some years ago. He said, if there's any major work that the bullion banks have to do in covering short positions or bombing the price, this is the way they do it. It's all planned in advance. What you're seeing out there is not free market at all. It's just paper trading by the bullion banks, and they're covering short positions like mad, both in silver and in gold. They'll never be able to ever get out of their short positions completely, but they're going to do everything they can to minimize their short positions. And what we're basically seeing, so this price management scheme started in 1975 in gold. And when they began this price management scheme 50 plus years ago, they had no idea how it was going to end. All they knew is they had to suppress the precious metal prices, starting with gold, obviously. and they had no thought was given to how they're ever going to get out of this thing. Well, here we are 50 plus years later. You know, the U.S., everybody, the West is up to their eyeballs in debt. I think the U.S. is what, 36 trillion in debt, and Britain's in trouble, Europe's in trouble, Canada, you know, where I live, is in trouble, Australia, you pick it, Japan. Anybody associated with the quote-unquote West is up to their eyeballs in debt, and the fiat currency system is coming to an end. And the powers that be in Basel or the Fed or wherever can see this coming, and we can all see it coming. If we can see it coming, you know, as in the blogosphere, people like yourself and me and a whole raft of other people can see that this thing is coming to an end. You know, the guys at the bullion banks, they may be criminals, which they are, but they're not stupid. And they say they're going to try and front run this thing, and they're just trying to get this thing, you know, sorted out before, you know, the system finally does fail. And so what we've been seeing for the last, back in 2008, where the central banks actually stopped being net sellers of gold, then turned into net buyers of gold. And they've been net buyers of gold for the last, 17 or so years. It's only in the last 3 years where it's really become heavy, where it's been 1,000 tons per year plus for the last 3 straight years. You know, they've been planning on this thing for like the last 20 years. And what we're seeing in the markets today with silver way up and gold way down is paper trading in the COMEX futures market, where banks like Citigroup and Barclays and Standard Charters and HSBC and BNP Paribas and Deutsche Bank, Canada's Bank of Montreal and Australia's Macquarie Futures and JP Morgan Citigroup, these guys are in the market right now covering as many shorts as they can. And these are what's causing these wild price gyrations, which are going to go on until they've done they've covered as many shorts as they can. But you know, silver is a special case. Like, I'll get back to that now. Is that, you know, we've been running a structural deficit in that now we're starting in its 5th year, and you know, as you pointed out, the gold silver ratio is like 104 to 1. It comes out of the ground at 7 to 1. Okay, 7 ounces of silver per ounce of gold. You know, silver should be 10 times the price it is today, right now. That's what it should be. It should be north of $300 an ounce. The boys know that. And the fact of the matter is that no matter what they do, even if the price management scheme ended tomorrow and silver went to $300 an ounce tomorrow, you know, the amount of silver coming in the ground isn't going to change. And it's going to take, like, I'm 76 now, and I will not live to see the supply-demand ratio or supply-demand deficit go back to where it was, where, you know, supply equals demand. It's just not going to happen because, you know, what's the deficit of 100 million or 200 million ounces? And you figure the average silver mine is pulling out about 6 or 7 million ounces out of the ground every year. So just do the math here. If you got a deficit of 120 million ounces and an average silver mine produces 10, and that's being very generous, okay? You're going to need 12 silver mines producing 10 million ounces a year to meet that deficit. Well, it ain't going to happen, okay? It's as simple as that. So the price is going to be high for a very long time before we ever see supply ever catch up to demand. And the bullion banks know that too. And all of us, including you, me, and all your listeners, you know, we're all in on silver, gold, or whatever. And when that day comes, is payday for us. But the banks know that too, and that's the day they're preparing for. And all we can do is sit around and, you know, blow the froth off a cold one and wait for this whole thing to resolve itself.
Yeah, how long do you think this could this whole Fiat Ponzi scheme that we've had since August 15th, 1971, how long more until it unravels, you think?
Well, here's the thing. It's either going to happen by design. The central banks of the world are going to say this. We're going to pick this day and this time, and we're going to pull our support from the dollar, and we're going to let precious metal prices run. Either going to be by design, or there's going to be some debacle in the world someplace. Something goes bump in the night over in the Middle East or in the Ukraine or heaven knows where, and that will be the start of it. But you know, we're so far down the path now that there's no hope of this thing ever being resuscitated. You know, Ted Butler, silver analyst Ted Butler, who sat this thing for almost 40 years before he passed away. thought this thing was going to end like 35 years ago, and then 30 years ago, then 20 years ago, then 10 years ago, and 5 years ago, and now we've been waiting here every year patiently while this structural deficit continues to build, and there's still no sign of it, in the price, and that's because it's being artificially suppressed in the COMEX futures market by these 12 bullion banks. But their actions over the last 3 or 4 years, especially accumulating gold and keeping silver prices in the toilet, it can only go on for a certain amount of time, and the price actions we've seen since the beginning of the year, are as far as I'm concerned, are the last desperate acts, especially the price action we've been seeing in the last 48 hours. Are the last desperate acts before they let this thing go. It's what I call their last swing for the fences. But whether it's going to end today, tomorrow, next month, or next year, we don't know. And I would bet money that the bullion banks don't really know how this is going to end when it finally does. But when it does, you don't have to know what day that is, because all you'll have to do is look at the price, and that will tell you everything you need to know.
Yeah, and you might even have a force majeure, or the COMEX and LBMA might just shut down because they won't be able to, there will be no price discovery. Do you see that happening?
Oh yeah, well I've been talking about that for 15 years now. It's something that Ted and I would argue about. He didn't figure they would ever let the COMEX close because that's where the price management scheme was being conducted. But things have changed in 15 years with the rise of China, and force majeure is very much within the realm of possibility. But as Ted correctly pointed out, 20 years ago, he says the CME group, the COMEX, and the LBMA have only one purpose, and that's to protect the short sellers. Okay, they're not there to protect the longs, or they're there to keep orderly markets. In other words, make sure the short sellers are protected. But force majeure is possibility, no question about it. And as you said, and as I've been saying for 15 years, the only option they will have if it comes to that is to close the COMEX and the LBMA and let the prices trade freely. And the only place that in the world now where you can trade a physical market only, okay, is the Shanghai Gold Exchange. And I suspect that if the LBMA and CME group are discredited, like the LME was discredited in nickel, 2 or 3 years ago?
Yeah.
You're going to see a shift from New York and London to Shanghai. It's as simple as that. And but I can tell you the process between doing that, between now and then, is going to be fraught with potholes and going to be very ugly. But the result will be, gold and silver and the other precious metals and a lot of other commodities traded without an options and futures market attached to it. And then for the first time in pretty much all of recorded history, we'll know what the true free market prices of silver and gold are, because, in our lifetimes and going back hundreds and hundreds of years, the prices of gold and silver have all been fixed either directly or against each other, and nobody knows what those free market prices are, but I can tell you they are magnitudes higher than they are today.
Yeah, I guess that what that will mean is that people who have gold and silver and commodities, they will have a lot more purchasing power relative.
He has the gold or silver will make the rules then. And as Alistair McLeod and I both agree, is that Shanghai and China has north of 25,000 tons of gold on their books that they're not recording, and they will be the masters, and they will set the price when that time comes.
Yeah, and I wonder if President Trump knows about that, because he said the other day that he who has the gold makes the rules. I wonder if he knows that China has a lot more gold than the 2,300 tons that is officially reported.
Who knows? But if he was smart, and he's got some smart people around him, and a lot of the people around him are gold bugs, So, he may know this, but whether he's prepared to do anything about it or not, I don't know. The deep state still rules the world in the U.S. and Europe, and they have, they're still in force, force to be reckoned with in the U.S. So who knows what he knows and what he'll be able to do regarding, China or the COMEX or, Fort Knox. It's. I mean, we're going to find out in very soon, I would think. But what you see out there is not even close to reality when it comes to actual prices, to what these prices should be.
Uh, Ed, just wanted to ask you if you could tell the viewers what do you think is the best thing to do in these chaotic, turbulent, volatile times in terms of gold, silver, and I don't know if you have an interest in the miners. Maybe you could give us your opinion. And before you do, Ed, I just wanted to show the viewers here that if they want to find out more about Ed, that they can go to his blog. It's edsteergoldandsilver.com. I'm going to put a link below in the description for that.
Okay, well, thank you very much for that. Okay, most people listening to this blog are already been in the market for a very, very long time, like months or years or whatever, and we're all waiting for payday, and we're all waiting for things to either melt down or blow up. So I'm kind of speaking to the choir here, but the first thing anybody should do if they're new to this is have physical metal in hand. Gold is very expensive. I mean, in the UK, it's worth, I don't know what it is in pounds over there, but in Canada, it's $4,700. At least it was yesterday. And in the US, it's what, 3,200. So we're talking a lot of money for a little 1 ounce coin. It really is. It really is. Like, I just cannot justify in my own height. Somebody says, here's enough money to buy an ounce of gold or 100 ounces of silver. What would I buy? Well, that's no brainer. Give me the silver. And with this gold silver ratio being what it is, and a reversion to the mean of heaven knows what, whether it be 20 to 1 or 15 to 1 or 30 to 1. I mean, silver should be well north of $200 right now. And so if you're going to get into this market, buy physical silver and hold it in your hand. I have a very, very, very large portfolio of silver and gold mining stock, mostly silver stocks. And I've had that now for like 20 years. I remember I bought Pan American Silver back in 1999 or 2000 for like $3. And Wheaton Precious Metals, I think just had an IPO. It just came out, and I think I bought 3,000 shares for 99 cents. Now it's like $100. So the stocks are going to be someplace to be, but you have to be careful with these because there's a lot of risk. So anybody buying stocks, if they're new here, do not try to rifle shoot this sector unless you're experienced. What I recommend people do is buy a good gold or silver miner ETF, like in the US it would be SILJ or GDXJ for gold, and that way you get a portfolio of 25 or 30 or 40 different gold mining companies, and you're sort of protected that way. And I own a lot of the Canadian equivalent of that, which is called 9-point silver equities. That's about 25 or 30 silver companies in a mutual fund. So I own it that way, but I own a lot of individual stocks as well because I've been buying this market now for 27 years. So I branched out, and I've been around long enough to where I know the company. So I'm not scared to branch out. But if you just want to play it safe, and I highly recommend this to anybody, even if you're experienced, put a chunk of money in these. In things like SILJ, where if one company goes under, it's not going to affect the portfolio. So physical metal first, shares second, and just sit back and, like I said, knock the top off a cool one and sit here and wait for this whole thing to implode or explode.
Ed, thank you very much for your time. And hopefully we'll speak again soon, and we'll keep an eye on these markets, and all the best.
Okay, thanks very much for having me on, Mario.
You're welcome. Take care. Okay, so I'm gonna